Hi. Today we're going to talk about risk engineering recommendations. We're going to talk about what they're used for. We're going to talk about how to evaluate them. We're going to talk about how to keep them moving and when and how to say no. So let's get moving and jump right into it. So risk recommendations come from the whole engineering process in the energy inspection. And what we're going to get out of it is a report. And the report, like we've said before, has many components. And one of the first places many people go is straight to the recommendations. I urge you to learn to get beyond the recommendations, even if you go there first. Keep going. There's a lot in the report that you won't get if you just read the recommendations. The way we deal with recommendations says a lot about how we deal with risk. And I can tell you that part of the reason for recommendations is to actually improve whatever the specific situation is. But also another reason is to gauge the insured's interest in managing risk. In other words, if they're part of the process, if they're part of trying to figure out how to implement the recommendation, if they're offering suggestions or alternatives, if they're getting quotes, if they're just participating, you can tell that's a whole lot different than someone who says we're not going to do it unless our premiums go down, or someone who says that, yeah, we're evaluating it, and every year they say that. So if you've got a 10-year-old recommendation on your report, let me tell you that that's doing you more harm than the actual risk of whatever it is that you haven't gotten to in the past 10 years, because you're paying premium based on your reputation in the market, and your reputation just keeps getting worse and worse the older these recommendations get. So we need to figure out how to move them. We need to figure out how to address them and not let them languish and age. So again, we don't want to ignore recommendations, but this is how they're basically used: to improve risk in the facility, to basically determine if the insured is willing to improve risk or not. As I just said, the willingness to participate in the entire disposition of a recommendation, rather than just being a stiff arm or just stubborn and saying you're not going to do it. Okay, they don't have to insure you either. So another tool, another use of this recommendation tool is measuring risk improvement. Some facilities just strictly look and say, oh, they completed some recommendations, they must be an improving risk. So that's beneficial. We want to keep that perspective alive, and that we are improving risk, we're interested in risk, and that we want to be a good risk partner. It can become a negotiating item. So if a recommendation is open and it's not finished yet, it can be one of the things that the underwriters will say, well, we're going to want more premium until it's finished, or they can say, come back to us and we'll give you a quote when it's finished. We actually had in writing an email from an underwriter 6 months after his engineer had made a recommendation. He wanted to know the status. Well, we weren't up to the next year yet, so the client didn't have a chance to say we're still evaluating it. It was only 6 months since it was issued. The information from the underwriter said that he'd like to know the updated status and what action has been completed on this recommendation. He said, no action, no quote. And that's what it meant, that if you haven't done anything in 6 months, don't bother asking him for a quote. He's not going to provide you one. So it can become a negotiating item. And just the other way, too, if you've completed some recommendations, it's possible to go in and then use those for leverage to show that the risk is improving. So it's important to address them and complete as many as you can. And we'll talk about the ones that you can't. Here's a recommendation that basically went ignored. If many of you know about some bushings out there that have a tendency to fail, and it's usually not a matter of if, it's a matter of when. And we've seen several of these. Hopefully the industry is done with this issue now, but honestly, what happened, many companies were told, hey, these bushings are failing, and if you don't swap it out, you're going to lose your transformer. And by the time everybody caught on board and saw them happening, the backlog of ordering replacement bushings was so high that some folks just got caught waiting. and they had 2 or 3 transformer failures while they were waiting to get their replacement bushings. So don't be like that. Get out there ahead of all these issues. If the recommendation is there in your hands, don't wait for there to be a supply chain issue when everybody else starts having the same problems. These guys that are coming out making the recommendations, they have their finger on the industry, right? They know, they feel the pain when they pay these big losses. So they're going to come out when they go to their other sites, and they're going to try and share those lessons learned. Let it help you. Let them help you. So when we're going to evaluate a risk recommendation to determine whether we're going to do it or not, what priority it has, and if it needs to be discussed, the things that I like to do, and this is a technique that I learned or developed working in industry, I figured we have to figure out what's the cost of risk, the annual cost of risk, and then what's the cost to implement the recommendation. So if we had some way to put a number on a recommendation, it makes it a whole lot easier to determine if the recommendation is worth doing or not. So how do we do that? Well, I started thinking, what is the annual cost of risk? It's the frequency of the event happening times the average loss, or times what we expect to happen. And that average loss is going to be both PD and BI, property damage and business interruption. For all my new risk engineers coming over from process and chemistry, glad to have you. Just an example, an under-turbine sprinkler system, back when we were doing this analysis, and this is based on if you lost that plant and you had to make up the production with another plant that had a higher fuel price. You lose a coal plant and then you have to start an oil plant. Well, that replacement power differential cost was part of the daily loss that we factored into this calculation. We looked at what was the typical downtime. How long would you be down from a particular event? Multiplied that by the replacement power differential cost, came up with what our business interruption exposure was. I'll let you know, we weren't buying insurance for that. And a lot of companies don't buy business interruption insurance. So managing that risk is not going to impact premiums. It's going to impact your bottom line. It's going to impact your profits, but not necessarily all in one year. So it's the kind of thing that you have to understand your cost of risk so you can make financial decisions, and you're basically trying to weigh the bet. You're trying to say, are the pot odds worth the stakes? And if they are, then we make the bet. If the pot odds are not worth the stakes, then we just pass. We don't play that game. So next thing, I want to show you this is what our recommendation system looked like. And what we were doing was basically, I've kind of blanked out a few of the locations, but it gives you an idea. We were looking at transformers and under turbines. And depending on the actual location, you might have a different business interruption potential than you did at another location. And the difference is just the size of the unit. Some of these units were base load, they ran all the time. We pretty much weren't able to put a lot of money and attention into peakers. They just don't run enough to have a lot of business interruption exposure to drive a calculation like this. So we looked at the property damage, the potential of having a loss, and I'll show you where all these numbers came from, the average loss and the average duration. I went out into industry and looked for the data that I could use. But in all these cases, you see a catastrophic and a non-catastrophic, and that just depended on what databases were available. Some loss types you can get just catastrophic, some you can get catastrophic and non-catastrophic. I used both because they both contributed to a different type of risk, and I wanted both of those frequencies to be captured so that when we looked at the annual cost of risk, we could see the paybacks with this non-catastrophic risk built into it as well. So anyway, you see what we did. We presented basically these payback periods of less than a couple years, and we showed that some of them were longer. And in fact, some of them were 10 years, 20 years. Some of them you never got the payback back. You never recovered your initial capital in terms of cost of risk dollars. So it's the kind of thing that helps make financial decisions. You wouldn't bet your life on it, but what you're going to do is bet your business on it. And it's full of opportunities for improvement. And the way I look at it is basically if, let me get us back into this one. If we're looking at a annual cost of risk and folks start to discuss the frequency with us, right? Like, where did you get those numbers? What is the frequency? And how do you know it's that and not this? As soon as they're talking about frequencies of catastrophic events, you've got them talking about risks, and we're managing risk. That's what we need them to do, is to think about it and talk to us about it. If they say, hey, this thing only happens once in a billion years, then we don't have to worry about it in our fleet. But if it happens once in the life of a plant and we have 10 plants, we might expect to have this thing happen 10 times in our life of operating these plants. So we have to look at the exposures that we have and look at the risks that we're managing. And the way I looked at the frequencies, I found databases. This is for all you guys out there who've read the Big Marsh study, 30-year history. They've updated it a few times, but you just go through and read the paragraphs and figure out which ones were catastrophic. And I pulled the data out, figured out that the average property damage back then, what the loss was. So, I had the number of losses. I had the bad events, but what I didn't have was what was the population size of the power plants that made all these events happen. That's the way to get the frequency. So I found a database with the Energy Information Administration and lined it up, matched up the columns to the years that I wanted, pulled out the nukes, pulled out hydros, just looked at large fossil steam plants and combined cycle plants, anybody that had steam units that could have an under-turbine steam fire. So I pulled all the data out, came up with some numbers, and that's how we got started. For the non-catastrophic, there was another database, and you'll notice it was an even longer period, more fires, much lower values, but still some business interruption. Average there of 39 days of business interruption. These days, that might not get past a deductible in an insurance policy, but it's going to hit the bottom line right away because you're not going to be buying insurance for any of it for your deductible days. So you don't want to have even the moderate event, the one that's non-catastrophic. Alrighty, how do we keep these recommendations moving after we've prioritized them, justified them, and we have the capital, and now we're out there trying to get the projects actually moving? Well, in my experience, what I've seen really work well is the single point of contact. Hopefully in corporate that they can call and they can set up the quarterly progress meetings involving the plant manager, the highest ranking person at that plant who approves all the budgets. That's who needs to be involved in every quarterly discussion, because hopefully they get tired of this and they don't want any more recommendations, and they do what it takes to get their quarterly meetings down to just 10 minutes. Let's talk about this one thing and we're off. So that's the secret behind getting them moving. It's the management commitment, and it's showing up. It's being part of those quarterly meetings. I love to participate in quarterly meetings when our clients bring me in. Sometimes they're a little concerned about an outsider. That's fine. I remind them that as a broker, I represent them, and I'm just there to help them understand what the insurance companies might think if they were to ask the insurance guys the same questions. So, some other ways to get them moving. If you just keep saying we're evaluating these recommendations, they never get done. But if you go out and get quotes, if you look at alternatives to what the recommendation was, if you commit to a schedule, and then you set up an action item tracking system, even if you get 2 or 3 years down the road with a recommendation, you're going to be able to show your progress. You're going to be able to show that we had these calls, and here's the minutes from those calls that we can talk to you about. And you won't have to worry about the markets basically thinking that you're ignoring the recommendation. So let's look at ways to show movement and to keep the recommendations up in the front and important for the operation of the plant. Now, when and how to say no, we have to be very careful when we say no, we're not going to do a recommendation. And it has to be after we've done all the analysis, after we've looked at the annual cost of risk, after we've looked at alternatives, after we've ruled out the things that we know we can do. Then we look at, what is the risk that we're going to really manage? What is the impact of this solution on risk? An easy example, I use it all the time, is the $1 million firewall in between the $500,000 transformer and the $500,000 switchgear building. So if you have $1 million firewall trying to stop from having $1 million loss, then you really wasted your money. And you can talk about business interruption, and if you stop the fire from going to the switchgear building, that it's going to be a shorter turnaround. No, the outage duration is going to be based on that transformer. The cost of the additional equipment in that building doesn't justify spending it all now. We might as well just go buy spare parts for the switchgear building, because that's more valuable than a firewall and keeping the old parts from burning. So, when you look at risk and you start to weigh what are we trying to achieve first, and then what's it cost to achieve, and does it make sense? You have to have that kind of discussion and that kind of thought pattern before you say no. So they'll listen to no. And believe it or not, the underwriters are sometimes the first ones that want to hear it. When their engineers go out and raise a flag, their underwriters sometimes call our producers and say, hey, can we get your engineer's opinion on this? And sometimes we have an opinion that helps them, right? If you've got a combined cycle power plant site and the fire pump doesn't start automatically, when the deep well pumps don't start automatically when the fire pumps start to refill the water supply, that gets the fire protection engineer's attention. And he tells the underwriter, and the underwriter says, whoa, what's going on here? Why don't you have these well pumps automatically starting? Well, let's go look at it. What do the fire protection systems protect? There's an office building, and there are hydrants around the plant. That's the water supply that's protected. All the units are protected with CO2 systems. So all the special hazards have nothing to do with the fire pump. That's just going to be the fire department who responds to use the hydrants, because our local guys, our on-site guys, can't use hydrants. And the fire department are not likely to use that local water supply anyway. So it really boils down to, if we made that deep well pump start automatically on a 6 million gallon tank, right, that only needs 1 million gallons for fire protection, we've got 5 million gallons of water before we even start dipping into the fire protection water. And you want the deep well pumps to start so we don't run out of water, when we're only going to be flowing water through one or two heads in a service building fire, in an office building, or they're not going to get flowed at all because the hydrants won't get used. So the underwriter hears all that and says, okay, my engineer was required to make the recommendation. It made sense that he made it. But now when I understand the entire picture and see all the risk, everything's fine. So that sometimes happens, okay? But it's not going to happen when you just say, no, we're not going to do it, or we're still evaluating it. It's going to come from well thought out reason and just showing that you're a partner in risk management and that you want to help reduce the risks.